Hey everybody, this is David Skrika here. So we'll get right into this day. So today we're going to talk about the Japanese carry trade because I really believe, and there are some articles now floating around about it, but when the market started to sell off big time late last week, I was like, what's really going on here? Like I was thinking to myself, for example, like like we know the economic indicators are weakening. Maybe the Fed is a little behind the curve, but it does look like if we were to start a recession right now, it'd be sort of a shallow recession, and it wouldn't be like a collapse or anything like that. And usually markets take a while to realize a recession. Now, I know that they're very, very overvalued now, but even look at 2000 when they were extremely overvalued. Really, it wasn't until you know nearly 8, 9 months after the top that the market really started to roll over, like late 2000, early 2001. So then when I looked at what the Japanese yen was doing, then I figured it out. I was like, oh, I'm sure this yen carry trade is unwinding. So what for those who don't know what the yen carry trade is the carry trades are mostly in the yen and the Swiss franc. So they're in these currencies that Japan and Switzerland are two of the most stable countries in the world, even with Japan's debt problems. They have stable populations. They're like advanced economies, etc. So Japan and Switzerland get a premium on their interest rates because of that. And in terms of Japan, they domestically own all their debt. So people, what they do is they'll go borrow in these currencies and then they'll speculate in risk assets around the world. And this is why, even though the Japanese currencies yield nothing, and Japan has had a pretty stagnant economy and obviously has zero interest rates, why the yen rallies when we have downturns in markets or economies. It's because people are unwinding the risk trades. When they unwind it, they have to pay back the loans in yen, and that means they have to buy yen to pay back that loan. So, and then of course that exacerbates the situation, because if you get a situation like we just saw where many NASDAQ stocks are falling 15-20%, you're long those stocks. Most hedge funds tend to be long on leverage, and then you have to go pay back that loan. And then the yen, you should see, rallies over 10%. Then all of a sudden you're down 20-30% on some of these positions, and of course they're leveraged. So this is the type of thing that could cause funds to blow up. When LTCM had positions like this, they would be leveraged 10-1. So of course, we lose 10-1. If you lose 20 or 30%, you lose 2 or 3 times your investment and you're finished, right? So that's the problem with these things, and that's why they can be so vicious. But what I want to show you right now is what this really reminds me of with the yen carry trade is 2007. Now, and it's similar to 2007 in that I remember in 2007 when this happened in February of 2007, a bunch of the smaller private subprime companies were going under, and people were like, saying that, okay, the smaller prime, these subprime companies are going under, and the economy's weakening. We're seeing the housing, blah 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 blah, and that's when you saw the first crack in this yen carry trade. There, you can see the yen went from it would have been about 120 yen to about, see this big move here. Same thing about as now, but down about 10%. And then, then the yen actually continued lower, and the carry trade continued until the top of the market. And then again, you can see in August, it really began to break again. But this first break here in early 2007 was the signal. So that, again, who knows? Maybe the same thing will happen now. Maybe the yen, after this spike, will start to go lower for a number of months. Maybe because we've seen this spike in volatility and we've seen a decline in the stock market, the market will go to new highs like it did in summer 2007, and then we'll see it starting. But I think the fact that this yen carry trade is starting to break is a sign that it really, really could move. And you can see in 2008, look what the yen did. The yen went from this 80 cents, which would be about 125, to 108, which would be like 90 yen. So the US dollar went down from 125 to 90 yen. Like the yen basically rallied 30% during the financial crisis. And again, that break that started first in the spring and then in the summer of 2007 was the sign. And even though the S&P, we'll show you the S&P here in a second, ultimately did go higher into the summer, that spring break was kind of the sign that these risk assets were about finished. Like, look, if you had sold there, yeah, you would have missed the last 100 points or 7% on the S&P, but you also would have not been a part of this. So I think that that's what could happen here. And like I said, it doesn't mean this is the exact top of the market. We know the Federal Reserve is going to cut rates. Like they cut rates right here in 2007, and that led to this kind of double top in the S&P. So so we know the Fed are going to cut rates. Will they do it cut? I think we would need something a little more to the downside, and something showing that the financial system is a little stressed. Maybe like some hedge funds will be in trouble from this yen carry trade. But I do believe this is the type of thing that we're going to see now on the S&P, or sorry, on the yen carry trade, that this could be the start of something breaking. And if we go look at like here, what you could see is, let's look at back again. We're going to go back to 2020. We're going to go to 2020, and we're going to start at the beginning of the year, and then we'll go to the end of 2020. And again, look what the yen carry trade did when the stock market blew up during the March, when COVID and everything was shut down. You saw the yen like completely collapse from this 89, so they've been 110 yen to again about 100. So and look how quickly it did it. This was just in a few days. So the market went down a lot more than it went down 30%. But again, you can see that what this trade happens. Now, it is true the market did rally the rest of the year, and you can see the yen rallied, but you have to understand the US dollar at that time, which we'll show you through the US dollar index, was very weak against all currencies. So you also have to take that into account. But notice that when the dollar rallied, remember the yen was rallying too. So the yen was rallying even more against other currencies than the dollar. And that same again goes for 2008. The dollar was strong during the financial crisis because again, it's global liquidity. And what happens in these global liquidity crunches, people are looking for US dollars because it's the reserve currency, and they kind of dive into that. So then they're paying back their yen loan. So that's what happens. But I just wanted to show you that. And I just wanted to show you that I do believe that this yen carry trade, and look, this trade hasn't been around forever because Japan has really only had zero rates for the last 20, 25 years, and significantly lower rates. Like, remember, during this rate high cycle, Europe, the United States, Australia, Canada, UK, almost every Western country raised rates to roughly 5%. Well, Japan kept their rates, like they did raise, and that's why the yen rallied a bit recently, but they've kept their rates below 1% because of their huge debt load. So that's another reason that this trade has been on, because Japan has continued to have it. Remember, you could just do a simple trade and that yen carry trade where you could have been, borrowing money in yen and then buying US, short-term US treasuries, borrowing money at 0.5% and buying money at 5%, and then taking that arbitrage. And remember, the yen was dropping. When the yen dropped 20 or 30%, not only did you make that 5% interest, but in yen terms, you were making 20, 30%, which made that loan also easier to pay when you brought it back. So that's the kind of thing that's been going on, but mostly it tends to happen in risk assets. People buy whatever, commodities, tech stocks, whatever it may be, these emerging market economies, things that are seen as more risk on. That's what usually happens. So I just wanted to show you that. And like I said, there's not too many analogies out there. There was really no sign of this yen trade back in 2020 because it just kind of broke when the market broke. But I think that what the yen is kind of showing us now is, we'll get a longer term chart again so we can see the yen. What the yen is showing us now, and look at, you can see what this is a pretty small blip longer term. And again, notice during the financial crisis, like I showed you, the yen actually kept rising into 2011. Again, like 2020 and 2010, 2011, the dollar was very weak against other currencies, but financial conditions were also tight then. I remember in 2011, that's actually when home prices bottomed. Maybe stock prices bottomed here in 2009, but home prices bottomed a few years later. And I remember going to Las Vegas, and a friend of mine who was a real estate agent had her assistant or her partner take me around, and you could get these amazing houses in Vegas, a mile or two away from the strip, with sunken living rooms and fireplaces and pools, and they're like $200,000. That same home was probably like $600,000 now. But guess what? You couldn't get a loan from the bank. You just had to buy that cash. That was what was going on. So, and then we can see when financial conditions kind of loosened, especially when the Fed started QE back in 2013, the yen weakened. So that's just kind of interesting. And one reason the yen has weakened so much since 2021 is in 2022, that is when the rate hike cycle started, and Japan did not really, uh, uh, participate in that. And that's why, even though markets went down. So again, it's not the end all be all, but I do think when you're in a risk on rally like we have been, and then all of a sudden the yen has one of these kind of basically reversals to the upside, and people have to unwind the trade, it can be a sign of bad things to come. You could see the rally the yen had in late 1999, right before the market began lower. That maybe was a warning of things to come. So I just wanted to point that out to people here. So, but it does really remind me. So I don't know what's going to happen now. I talked about the VIX at length yesterday. I don't need to talk about it again. But the question is this: do we see one of these rallies like 2000 or 2007 where the market goes back to the highs? Do we see something like February 2007, where the market actually goes up to a more significant new high? Maybe that would happen at the end of the year. Or do we see, or even 2018, when we had this unwinding of a volatility trade, the market got smashed in February, went to a slightly new high in October, and then started a bear market. So do we see a slightly new high like 2018, 2007, 2000? Or is this a double high, like a double top high? Do we just see a retraction? Do we see something that's a little more significant? Maybe this ends up being a very short-term trade, because right now Japan probably is not going to boost or move those rates lower anytime soon. And now the US is going to move rates lower, and probably a little more aggressively. We're probably talking 75 to 100 basis points by the election over the next 3 months. And that was only expected to be 50 basis points just a few weeks ago. So I'm going to leave it at that. I just wanted to show you how this yen carry trade works. And I think this is unwinding. And one thing about it is I do believe that when you're in cycles where that carry trade was, carrying a lot of the risk on trade, it will ultimately lead to the end of risk on. So I hope you enjoyed this video, and everybody take care.